Crude oil prices surged last week, closing at $74, a gain of more than 4%. This marked the highest settlement in over 2 months, driven by a combination of bullish factors, including economic stimulus measures in China and forecasts for colder weather across Europe and the US. These developments were interpreted as supportive for near-term demand, propelling prices higher into the week's close. China continues to fuel market optimism with a series of economic stimulus initiatives aimed at revitalizing domestic consumption and industrial output. Recent measures, such as higher wages for government employees and increased funding through ultra-long treasury bonds, underscore Beijing's commitment to stabilizing economic growth. These steps have eased concerns about sluggish demand and provided a positive backdrop for crude oil markets. Analysts highlight China's consistent rollout of stimulus measures as a pivotal influence on oil price expectations for 2025. The anticipated acceleration in economic activity from the world's largest oil importer is helping to establish a price floor for crude, counterbalancing worries about oversupply from non-OPEC producers. Weather forecasts also played a role in supporting prices, with colder conditions expected in the US and Europe boosting demand projections for heating oil and distillates. Giovanni Stanovo of UBS noted that winter weather could significantly increase short-term oil consumption. The latest data from the U.S. Energy Information Administration added to the bullish sentiment, revealing a 1.2 million barrel draw in crude stockpiles, bringing inventories down to 415 million barrels. While the draw was smaller than expected, it signaled tightening supplies. Meanwhile, rising gasoline and distillate inventories reflected increased refinery activity as utilization rates climbed. Despite the upward momentum, crude oil prices face potential resistance from a stronger U.S. dollar, which posted its best performance in nearly 2 months. The dollar's strength, driven by expectations of U.S. economic resilience and sustained higher interest rates, could dampen global oil demand by increasing borrowing costs. Investors are also keeping a close eye on Federal Reserve policy signals. Any indications of rate cuts could further stimulate economic activity and energy consumption, while the absence of such measures might cap crude prices near current levels. Crude oil prices are expected to maintain a bullish bias in the short term, supported by economic stimulus measures and seasonal demand. However, upward momentum may be limited by a strong U.S. dollar and the risk of oversupply from non-OPEC producers. Market attention will center on upcoming economic releases and inventory reports for insights into the evolving supply-demand dynamics. Key technical levels include weekly support at $71 and resistance at $74. A breakout above $74 could pave the way for further gains, targeting the $75 to $77 range. Conversely, failure to sustain current levels might see prices retreat to a range-bound pattern between $71 and $69. Please like, subscribe, and comment to support the channel. See you in the next one.